Hey everyone, Steve here from 11 is a channel where we talk about lucrative investment strategies and opportunities based on the requests from the 11 Collective. Today we have SJ with me. She's also based out of Silicon Valley, and she's a successful entrepreneur, an investor, and a lawyer for small businesses. She primarily works with startups and SMBs in the food, retail, and service sector, and we have the pleasure of having her on our show so that we can talk about IPOs. There's been an onslaught of IPOs, and I really want all of us to fully understand what that means for the businesses and how that affects our investment. So without further ado, hey SJ, how's it going?
Really good, Steve. How you doing?
Perfect. Really appreciate you jumping on the call with us today. I know you have kind of an expertise, and I really want to get your perspective on this. Can you start off by telling us what is the point of having an IPO in the first place?
Money, Steve. It's not the full point, but it gives companies more access to capital. It's open to the public now.
Yeah.
People can invest and they can reap the rewards of this investment, especially if they believe in the company and it's in a very positive trajectory. It really is about the money. Also, the secondary effect is it kind of solidifies your entity's credibility. It makes it more visible to the public. It increases brand reputability. You become an entity that is at a different level of business. You're no longer an awkward adolescent stage. I like to call it the teenage stage of like right before a company goes public. You know, it's like kind of awkward. Is it going to go public? Is it not going to go public? And then once it does, it's supposed to be mature. And it's supposed to be a pretty solid company at that point.
And I think you put it in a very succinct way, because ultimately when you're investing in a company, brand awareness means a lot. Whether you're the business trying to acquire more customers or you're an investor trying to figure out what this business does, the brand awareness plays a big piece. And similarly, I really want to deep dive on the bit where you said about money. When a company goes public, what are your thoughts in terms of like the direction of the money flowing? Like, what is the primary objective of an IPO in terms of money?
As a company, you have a greater pool, greater access to funding. And what it means for the shareholder, the person that's investing as the company, is that, before, even at the formation of any corporation, no matter what, the definition of it from a financial standpoint is to benefit its shareholders. A corporation wouldn't mean anything unless it actually is profitable to its shareholders, because of all the regulation and the scrutiny and the financial scrutiny that takes place to even get to a point of an IPO and beyond. That now there's a greater access pool of funding, and that money usually goes to building the company so that it becomes even more solid than what it is. So the whole idea is the money that's raised by shareholders will help with the growth and the expansion of that business entity and furthering its mission, and maybe even creating different flows and streams of revenue, which would be beautiful, but that doesn't happen right away. It happens in time, but access to money helps the corporation grow. I don't want to sound like a cuckoo, but the way I think of business entities from the very beginning, it's kind of like a human being, So it's the founders, they've created this separate entity, separate from themselves, and they put a lot of tender, loving care and affection into it. They start hiring other employees that bring in tender, loving care and affection. They are putting their human resource capital into it. They're believing in the mission. They're moving it forward. There's a lot of ebbs and flows of a startup life, as you know. Both you and me know this. But then once it gets to the point of it's going to take it to the next level of being public, it doesn't mean that it really does have to take it to that next level to be a legit corporation. It just means now that it's going to be offered to the public, so there's a more share of shareholders that will be involved in it. There's a different degree also of duty. The corporation itself is growing within so that it becomes more solid. It becomes an entity that's going to stick around forever, even after the founders die, because human beings dies, but entities live forever.
Mm-hmm.
And the people that benefit from the entity internally, those employees, and externally, those shareholders, will continue to feel the fruitfulness of that investment for eternity and beyond. So it's like its own ecosystem. Every corporation should be viewed as its own ecosystem that is evolving, and, it starts on, in a little place, and it grows and becomes bigger and bigger and bigger. And I always believe in the good of entities. Normal people, we go to the store and we buy things, and we don't know where those things come from. But every single little thing that we use in life, it came from a business. At least one human that founded it, that had that idea, whatever it is.
That's right.
Whether it's, a marketplace on Amazon, or if it's a groundbreaking technology innovation, everything started from a business.
Yeah, I think that's a really interesting way to put it. I mean, ultimately, especially as a legal entity, a business is considered its own entity, right? Both to protect itself as a business, but also protect the people who are building this business, so that they're willing to do a new idea while minimizing the risk against themselves. And I think that's super important, and one of the biggest drivers in America that helps people create businesses without the fear of failing and losing everything. One of the things that you did point out is that, at least my interpretation of what you said is that a huge part of creating a business and then going public is to generate value for the shareholders. And especially as a short-term thing, it comes with a caveat that, at least my interpretation, please correct me if I'm wrong, the internal shareholders, in other words, the employees who's been grinding it for years, takes precedence over the outside shareholders. At least that's the assumption that I take. What are your thoughts about that?
That would be a good corporation. That would be a good one. The one that cares about the human time, the blood, sweat, and tears that these humans internally put into the entity to get it into the place that it's at, which is why a lot of people that work at startups, they get a little piece of the pie. They get first dibs in being a shareholder of the entity before it's even offered to the public after it goes IPO. So yes, but then also it depends on the corporation. It depends on the vibe of that corporation. Just like with humans, every human has a different reason for why they do certain things in their life. And some, they believe in different things or whatever. Same thing with corporations. Corporations are an extension of the founders, especially in the beginning stages, but they take on a culture of its own. And it just depends on where the corporation is at, what phase that entity is at, for you to really see what it really is committed to do. I think that every corporation, we can say hands down, has a mission. And whether that mission is formally put on paper and relayed to the public or not, there is a mission, and that is the mission that that the company, that entity has, that it wants to further, which then will benefit the shareholders and benefit the employees.
Yeah, that's fair.
I don't know if that answered your question.
No, I think it's fair. I mean, I think what I'm trying to do is create a more generalized perspective, and I think you're fairly preventing me from doing that. I think maybe another way to look at this, if you will, is if we're talking about just the first, let's say, 6 to 12 months of a company going public. Because one of the things you touched on is that when a company goes public, it's basically trying to create a fundraising opportunity for the business so that it can grow a certain way or tackle a certain project, having a giant infusement of money, right, to create this opportunity so that they can realize the opportunity, right? So if you agree with me from that perspective, at least, do you think for the first 6 to 12 months, is it more about the business creating value for itself versus creating value for the shareholders?
So here's the thing. Once you have a private firm that's deciding to go IPO, internally, like they're in-house, there's a lot of things going on to ensure that, I guess you're right, to ensure that the shareholder down the line, that public shareholder, is buying into whatever they're advertising the company is shaped up to be internally. Because these shareholders, they don't work internally, they just see what's on paper. The biggest thing is always accounting, because that is part of the heavy regulated SEC endeavor that every single entity has to go through to have their books audited and to ensure that it's done in a certain way, and there are filings that are made to ensure that. So the public then is put on notice that this regulatory body received all the paperwork that it was supposed to receive from this entity, and this entity did what they were legally supposed to do, so that they can be fit enough to then offer an interest of their entity to these shareholders. So you are right with having a benefit. They start prepping themselves so that they can be valuable, and that value can be solidified, and then they also are minimizing their risk, so that once they do go IPO and now they have people that are not employees of the entity but people from the outside buying into them, they will lessen their risk of having a lawsuit that is along the lines of fraud.
That is such a lawyer thing to say.
Like false advertising.
Yeah. That definitely, actually, that addresses another topic of mine, which is, you see these companies go public, and then, the stock gets hyped up because of whatever vision that either the news or the company puts out. And the next thing you know, because the vision didn't get realized fast enough, or whatever problem they run into, suddenly some lawyer corp thing decides to sue the company for misleading the shareholder. That's kind of what you're referring to, right?
Yeah, that's right.
That I find that really disappointing, frankly, because at least from me as an entrepreneur, like, you're doing your best to create value with your baby, and sometimes stuff just doesn't align, right? And the next thing you know, people are suing you for it. But I suppose that's the risk you take on, or the additional challenge that you take on as a public company.
Yes. And at that point, it's really important to understand that each entity has statutory duties that it has to itself, its people, and that certain people have to the entity where they have duties to it, so they're not putting it in a bad position, and that entity has to the shareholders, so that it's not putting the shareholders in a bad position. So it's like this circle of love full of all these fiduciary duties that each of these parties have to each other, to try to minimize as much as possible any type of false advertising, which is not the proper terminology to use here, but it's the kind of the perfect picture that I want everyone to have in their head of what can happen if we have this hyped up entity and it may be hyped up for like a second, but if it doesn't actually follow through with what it stands for, that hype pops, and it puts the people that either invested in it when the hype was up in a really bad position, because that's investing on hype. It's not investing in a solid entity. It's investing in a very risky, maybe short-term type of endeavor where there may be an upswing, but it will be short-lived most of the time. And that's why it's really important to kind of really understand these entities, how they work on the inside. Like, how does business work in general? How does a particular entity work itself, to even know if it's worth the risk, right?
Yeah, I think that's a really eloquent way to put it. I mean, between you and John, who used to work as an investment banker for Goldman, I mean, I think the more you understand how a business works, the more it's logical for an investor to invest for the long term, because the short term window, how you look at a company in the short term, either you're consistently benefiting because you have an edge, because you maybe work in the industry, or maybe you have insider information, which is technically illegal. But unless you have that, the surefire way to make money is investing in business value, in the proper leadership, and going for that long-term vision. That will help you make money for the long run.
Yes, which brings a very good point with when these companies are thinking about going IPO, there's a certain, things that you could see structured inside of what they're trying to do so that they can be a strong company when they're offered to the public. Because again, the company itself is trying to minimize its risk from a potential shareholder lawsuit for mischaracterizing itself,
Yeah.
So what usually happens again is the accounting, the record keeping, everything becomes super tight. There's certified and everything that you could think of, everything is audited. There's policies that are put in place. Those policies are enforced. And then you start to see kind of like a shift in management as well. You start to see the hierarchy of the entity, even though you and I in the Silicon Valley, we're surrounded by organizations that consider themselves flat organizations. I think we hear that all the time.
Yep.
In order for it to go public, though, there has to be a hierarchy of who's in command of what, and
Right.
that hierarchy, each person in a management role, senior management role, has managers underneath them and a pool of people underneath those managers. So everything is departmentalized and organized so it can function like a very strong, viable entity. So then you start seeing those things happen when they're starting to fill in certain roles in their chief roles, making sure that all those chief roles are filled out properly, all their senior management roles are filled out properly, having the right departments departmentalized. You start seeing that if you're working from the inside.
Right.
But then also you start seeing them cut off a lot of fat, because the last thing that these entities want to do is go public and then they get the shareholder money. And when they get the shareholder money, they start spending it on things that aren't really necessary. So now is their chance to tighten the ship, to clean things out, to make sure that it's running like a very well-oiled machine. It's done like that on purpose because it needs to be as well-functioning and stable as possible before opening itself to the public. Because if it opens itself to the public and then the public starts investing, and then you have really angry investors because they're losing money, they're not making money, not only is that a complete just opposite objective of an entity and why an entity exists, because just like we said before, an entity exists for the value and the profit of shareholders, but it's also a breach of so many different things. So as a person that is looking at entities to invest in as well, even if those entities have existed for a long period of time, you could really know where that company is headed by looking to see who are its leaders, who are the people behind this entity that are influencing its culture, that's influencing the way it's navigating this business world, and where does it stand in the business world. So these are all really good kind of general tips, but also a little bit in the inside to show how things start to bubble up so it can get to that phase of being offered to the public. And even after that point, why it's really important to look at the same things that the company had to do in order to go public to ensure that it's still a good investment.
Yeah, that makes a lot of sense. I mean, it's kind of an inside joke because we're in the Silicon Valley, but you know, a lot of our audience members are not. If you work at a startup over here, every company internally says they're gonna go IPO in 12 to 18 months every single year. That's that's just how it is. But as you pointed out, you know, like there's gonna be a certain point where you're gonna start noticing the leadership's gonna change. There is gonna tighten up. You're gonna notice the processes change. The organization's gonna change. They might switch off of from QuickBooks and into something more professional. All of these little details is what you actually notice that okay, you're finally ready to go IPO. You know, actually, one thing I was kind of curious about is how long does it usually take for a company to go from preparation to actually go IPO?
I know you're going to hate this answer, too, but it really does depend on each entity, and it also depends, especially in the world that we live in now with SPACs.
Yeah.
It depends, which speeds up the process enormously.
Yeah.
But if a company is trying to look at like the traditional IPO route with doing things on its own, it usually takes like from the time that it decides that it wants to go IPO until it goes IPO, I would say fairly like 3.5 to 4 years.
What?
Until it's like, because if it's done the right way, because internally, there are a lot of things from a legal standpoint that need to happen, as well as from if you're starting from like just the idea of, yes, I would love to go IPO, and you know that this is a clear objective for your entity, it can happen faster, especially if things were set up from the beginning.
Right.
But think about this. Once you kind of make the decision that you want to have a very formal entity structure, and once you make the decision that you want to set yourself up to go IPO, you have to change a lot of things internally, like we just talked about.
Yeah. I
mean, even finding people and hiring people for these C-suite or senior management positions. Yeah. I mean, it's very hard, and it takes time. Then, even from an accounting standpoint, to get the right partners involved to make sure that your books are being properly kept and they're in the right condition, that takes time too. And then the insurance part of things, just to court different insurance companies to see which company can actually take you public, that too takes time. It won't happen overnight. That process alone takes maybe 8 to 12 months.
Sorry, when you say insurance, you mean like the underwriter that takes you public, like Goldman or Morgan Stanley? Is that what you meant by insurance?
Yes.
Oh, okay.
Yes. But usually what happens is those companies, they set you up from the beginning too with your business insurance that you need to have in place too, to take it to the next level.
I see.
Directors and officers liability, that's a kind of a big deal. Once a company goes IPO, a very good directors and officers liability package needs to be set up so that if crap hits the fan, your people that are there, and they are on the front lines, and this is why a lot of people are investing in the entity, because they believe in these leaders. They're protected. That's
fair. Yeah, I mean, I think from my background, because you're in a different department than me, right? And from the product side, we've actually always talked about the internal timeline, that when we start talking about IPO, it's usually at least optimistically 6 months, but usually 12 months. But I think the caveat here is that you have a more holistic perspective, where probably a lot of the stuff already happened. Like I already took granted that a lot of the moving parts already happened in the previous years, and I'm talking about like the next steps, and which is usually for the audience is usually when you hit the $1 billion valuation mark. Then we're like, this is official now, we're going IPO, and that usually takes about 12 months from my experience.
Yeah.
So thanks for that. The next question I have that I'm super interested in, and I'm sure a lot of our viewers are too, is can you give us an insight on how the share price is set?
Usually, these companies go through internally a lot of different rounds of funding, right?
Yeah.
So a company can go through the alphabet of different rounds of funding to get to the point of it being ready to go IPO.
Yep.
And the most important thing is not to shortcut the investors that have invested from the company from the very beginning when it was nothing but just an idea, and it didn't even have a proven source of revenue up until those that, you were creating this cash flow and you were selling at a certain valuation of what the company was valued at and the per share price. So you kind of have to think about the company internally of making sure that the share price that is set for IPO, it's based on the valuation of the company, and it's not super inflated. You have the financial data to back it up. And this is, again, the financials that are all regulated, that must be audited, that you have the forecast and the balance sheets and the income statements that have all just been checked off, and there's no funny business going on in them.
Yeah, that's fair. I mean, I think that was a very politically correct way of putting it. I mean, I completely agree with what you're saying in terms of, the numbers have to be, there's a consistency behind how the number is created, right? Like, I'm completely with you on that side. The curiosity I have is, how come every time you go IPO, the stock would blow up like super high, even though most stocks, I don't think I've seen a single IPO where the stock held on for the first, let's say, 3 weeks. It always start trailing down. Who's the majority of the investors that's driving up the share price on, let's say, the first day of IPO? Is it institutions that are doing this, or is it just purely retails who are driving the stock price up because of hype?
I think it's really nowadays it can be a lot of the independent investors bringing up and collectively really hyping things up. And then once it doesn't pan out to be what it is, they pull out, and then it flattens, and then it's a weird situation. We are in a very different time right now. It's a weird time financially. And even with how companies are going IPO, there's, for example, with the SPAC, like, this is the first time in history that 65 companies have gone public through a SPAC. Like, it's crazy to me. This is the first time ever. I don't know. I think it's going to be exciting maybe next year if we look back to this year and really analyze how things went down. That would be a really cool case study. Hopefully next year you and I could sit back and talk about it.
Yeah, absolutely. I hope you didn't say how things went down in an ominous way.
I'll try.
Yeah. I mean, I totally, we should definitely circle back on this. Because one of the things that I was taught both in school and a lot of my professional investor friends communicated to me that, many times you're going to start seeing a huge uptick of companies trying to go IPO, because it essentially, like we previously talked about it in the beginning, the point of an IPO is for them to have a huge infusion of money with very, very little amount of
what's the word? Not risk.
Liability. That's what I was looking for.
Yeah, liability. Okay.
Yeah.
Okay.
So when a company goes public, it allows them to have a huge infusion of money if they can create that hype. And they can have this huge infusion with very little amount of liability, as opposed to a company that needs a huge amount of money and don't do the IPO route. They're basically asking for VCs or banks for money with interests attached, right? They're giving away equity, or they're giving away an interest every single year. And so it incentivizes everybody to go public if they can. If there is a perception that the economy is about to go shaky for the next 4 or 5 years, there's actually a known thing that a shit ton of companies are going to start going public, because once the economy goes to shit, it's very hard for you to go public at that point because you won't get the same stock price as opposed to getting the stock price when the market is hyped up. So many of my friends who are professional investors are saying that this is one of those factors that is driving the uptick in the stock IPO thing, and we should all actually be very, very cautious in how we invest in these companies.
Yeah, I was actually reading an article too about there are more investors than ever right now, just because of the fact that everyone's home.
Yeah.
Everyone's home, and there are some of those that receive stimulus money and are willing to gamble it. Try to get a piece of the pie. So we have a lot of first-time investors now in the market.
Right.
And then there's also different resources that during our time, like you and I growing up, we never had a Instagram or even the TikTok or the Facebooks. I think what we had during our time was more of going on Yahoo Finance or some site like that and trying to do our research on different threads,
Yep.
So it's a different time, and I think that there is a different breed of investors out there that are willing to make more risks, and they are willing to buy in to different stocks, which also increases the hype of those stocks.
Yep.
It's an interesting time.
Absolutely. So, I think the summary of this podcast is that, I hope you guys got a little bit of visibility in terms of the point of an IPO that is ultimately business-centric, create value for the business so that it can create more value for the shareholders later on, as opposed to just a cash-out opportunity for investors. But at the same time, because of the advent of social media, really, the pump and dump idea, the pump and dump strategy is now more real than ever. So everyone should be a little bit more careful in how they invest their money. That being said, there's plenty of money to be made. You just got to be careful about the information you're receiving and how you're treating that information in relation to your investments. All right, SJ, I really appreciate the explanations you gave us. It's really helpful to help us better understand how IPOs work and what that means for us investors. We'll definitely circle back with you, talk a little bit more about more interesting topics and also this as well, so we can use this as a time capsule, get our facts straight and see if it aligns.
Sounds good. Thanks for having me.
All right, thanks. Talk to you soon. Thank you.